everyone, welcome to our Principles of Accounting 1 tutoring session over a Chapter 11 Stockholders Equity problem. Tonight we're going to be doing two problems. We're going to be doing Exercise 11.2 and Exercise 11.6, which are on pages 605 and pages 607. So let's just get into it. Exercise 11.2 says that Fagan Company had these transactions during the current period. Okay, it says June 12th. They issued 80,000 shares of $1 par value common stock for cash of $300,000, okay? So we automatically know that we are increasing our cash by $300,000. So we can debit cash by $300,000, okay? And then for these problems like this, when you have a par value that's lower than your cash amount, then the multiplying of your market value, which is what they just done for us, you're going to have common stock and paid in capital in excess of par, okay? So we know that our debit is $300,000 for cash, and we know that one of our credits will be common stock at the par value. So we have a credit of common stock for 80,000 shares multiplied by $1 par value, okay? And then right then we have a debit of $300,000 and a credit of $80,000. So that doesn't balance, so we know our debits and credits have to equal. So to find out your paid in capital in excess of par value, you can either subtract $80,000 from your $300,000, or as a check figure, you well, it doesn't apply to this one because it doesn't give you the market value, but I'll go ahead and tell you. Another way you can do that is you take the amount of shares multiplied by the difference between the market value and the par value. Okay, so this one it doesn't give you that, but just know that clue, and that's a check figure. It shows that you multiplied the first two correctly if you got that one correct. So for that, just first, I'll go ahead and show you all of it, and we'll just keep going. So that is what we just did. We've got our cash of $300,000, and then we've got our common stock at our par value, and then we've got our paid in capital in excess of par for common stock, which is $220,000. Okay? So going on to June 11th, it says we issued 3,000 shares of $100 par value preferred stock for cash at $106 per share. Okay, so now we're dealing with preferred stock. In the last video, we talked about the differences, so make sure you note those. So for this, again, we're going to have a debit of cash because we're increasing cash. So the cash, it says that we issued the shares. We issued 3,000 shares at $106. So our debit of cash is going to be our 3,000 shares times $106 because that's the market value, okay? And then the same thing we did in the previous one, problem on June 12th, you're going to credit preferred stock, okay, at 3,000 shares times $100 because that's our par value. And for the trick that I showed you or mentioned in the last problem, for your paid in capital in excess of par, you can do the amount of shares, which is 3,000, multiplied by the difference between the market value and the par value, which in this case it would be 3,000 shares multiplied by $6 because that's the difference between 106 market and $100 par. So for that one, go ahead and show you all of it again. For that one, it was this. It was our cash of our 3,000 shares at $106 market value. And then we've got our preferred stock and our paid in capital in excess of preferred stock. And again, those equal. Okay. Another type of stock that we're dealing with on November 28th, it says we purchased 2,000 shares of treasury stock for $9,000. Okay. So in the previous video, I explained what treasury stock is, so make sure you have an idea about what that is. And for that, you're just increasing treasury stock, and because you're paying it, you're going to credit cash. So that's your answer right there. Okay, so feel free to pause that and check that with your own work. Okay, so that was exercise 11.2. That was dealing with issuing stock. Okay, so the next problem we're going to do is exercise 11.6. It's on page 607. So this one is dealing a little bit with both how you've issued some stock and things like that. But for part A, it just says prepare the entries, if any, on each of the 3 days that involve dividends, okay? So for this one, I'm just going to go over part A for this. And so we know we started with 60,000 shares outstanding, okay, and we sold 9,000 more, okay. Then we declared a dividend on June 15th, okay. So in the previous video, I said that you've got 3 days. You've got the declaration date, which is the day the board of directors claims a dividend. You've got the record date, which is when the managerial staff goes and looks to see who owns stock on so-and-so day to say that they are the ones that get the dividends. And then you've got the payment or distribution date. This is going to be an example over a cash dividend, but you still need to know how to do a stock dividend. And if you want to do one of those exercises, jot down exercise 11.7. I don't know if that's one of y'all's homework problems or not, but that one goes over stock dividends. So for this one, like I said, we're just going to be doing a cash dividend. So for exercise 11.6, the first day that we have involving a dividend is June 15th. It says declared a cash dividend of $1.50 per share to stockholders of record on June 30th. Okay, so what that's saying is that we're going to pay every share. If you have 100 shares, you're going to get 150. Well, you're going to get, if you have 100 shares, you're going to get $1.50 dividend on each one of those shares. Okay. So the first thing you're going to do is you're going to debit cash dividends, okay, and you know that you have 69,000 shares outstanding, okay. So for that first entry, it's going to be 60,000 shares times $1.50, okay, and because you're declaring it, you're also going to have a liability eventually pay that, so you're going to credit dividends payable. So right here you've got your cash dividend and then your dividends payable for $103,500. Okay? So that was your declaration, excuse me, that was your declaration date. And one thing you could notice, okay, I don't have it written out on my example, I should have, is on June 30th, that's your record date. There is no journal entry for accountants on the record date, okay? So you don't have to journalize anything for the record date. So it's just the declaration date and the payment date. So on the payment date, okay, you've already declared the dividend and you have a liability to pay it off. But on the payment date, you're actually going to be paying off the dividend, okay? You're paying it. So if you no longer have the liability, just like we learned in the first couple of chapters, you get to debit your liability and you get to credit cash because you're paying the dividend, okay? So to pay the dividend, the payment date, it would be this. So you would debit dividends payable and credit cash, okay? So the second exercise, the second day that deals with dividends is December 15th. So it says on December 15th, it says declared a cash dividend on outstanding shares, $1.60 per share to stockholders of record on December 31st. Okay. So if you would have read a little bit more on the problem or journalized them for practice, you would have recognized that we have issued 4,000 more shares. Okay. So for that, if it just says we declared it, we haven't paid it yet. So it just wants you to practice journalizing the declaration date. So again, it would be cash dividends, multiply the amount of shares outstanding multiplied by the dividend amount, which is $1.60. And so you would debit cash dividends and credit dividends payable, just like here. All right. So in this video, we've gone over dividends and how to record stock. I hope that was helpful, and those are the main ideas you need to know for Chapter 11. I'm sure you'll have problems very similar to those either on your homework or your exams. So as always, if you have any questions, please post them to this discussion board on Moodle, and I'll answer back either in another video if it's necessary, or I'll just reply back to you in a message. So I hope that was helpful, and we'll see you next time.